So let's start with trend number 107. And I want to warn you, this is going to go probably for a half hour. The other 6 trends will go through quickly because I've got to go through sort of a primer to educate you why this trend is occurring. It's the shift from being product-centric to customer-centric profitability analysis. Products and standard service lines are not the only thing which accountants should compute costs for. What about all the costs that have nothing to do with making products or delivering standard service lines? The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture. And I'm going to make a case that the bottom half is more important than the top half. And incidentally, the reason I refer to standard service lines is because many organizations do not make products. They don't make things. They are services like insurance companies or travel agencies with the reservation. They have outputs, but so the principles of management accounting apply to service industries as well as manufacturers. Now, to basically validate this is important, trend number 1, is this is a survey from Gartner. Look at the 2 top most important CEO concerns: attracting and retaining loyal customers, increasing market share. Now, visually, what I'm saying is if this was the expenses and margins of an organization, let's say last month or for a quarter, it's the white space, the entire rectangle is all the spending, but the dark space is only the product or service line. The white space is really more important. Management accounting, the best and most profitable types of products, channels, and customers to retain, to grow, to win back, and acquire. Which products and channels and customers maybe to drop in, and do traditional cost margin analysis. So this is what led to activity-based costing, because the way the accountants have been allocating overhead is basically spreading it like Stan ABC. Imagine you go to, and incidentally, most managers don't trust the management accounting system. They know it's wrong. The external reporting, yeah, that's correct, but that's for compliance, and they take simple actions there. So the easiest way to understand ABC is this. Imagine you go to a restaurant with 3 other friends. You order a little salad and the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, that's how products and standard service lines also feel in a general ledger standard cost accounting system when the accountants do take this large amount of indirect and shared expense, commonly called overhead, and they allocate it like spreading butter across bread. They use factors like number of units produced, number of labor hours, sales amount, square feet, number of employees, head count, square meters. None of those factors reflect the unique consumption that the various products and service lines consumed of the end-to-end business processes and the work activities that belong to the processes that are drawing and consuming this spending. So the simple way of defining ABC is as if the waiter, and incidentally, the result is that compared when you do it correctly, decomposing the indirect expense, you'll discover that some of the products are overcosted and the others must be undercosted because it's a zero-sum error game. And this means the accountants and the CFO are providing their managers flawed and misleading information. So the simple definition of ABC is as if the waiter or waitress brings 4 individual checks. You only pay for what you consume. What's led to interest in ABC over the last 40, 50, 60 years is this diagram. It shows the 3 universal components of any organization's expense and cost structure. But you'll see over the decades what's been happening is the indirect expense, commonly called overhead, has been displacing the direct. And when you ask people why, they think, well, maybe machines and automation and robots, we're automating out the frontline workers. That is secondary. The main explanation for this shift in displacement is this. All organizations have had an increased proliferation of different types of products, more colors, more sizes, more ranges. Banks have more type of a depository accounts, insurance companies, all sorts of different types of policies. And the point is this: whenever you increase the diversity and variation of the outputs, it just produces complexity. And complexity causes the need for more and more indirect expenses to manage it all. So 50, 60 years ago, when most of the things were direct costs, it was simple, few products, okay, you could allocate that overhead incorrectly because the majority of the expenses were accurate from the direct. But now look to the right, that's not the case now. The indirect is much larger, so we need to basically do a better job. The problem actually begins with this traditional responsibility cost center statement. Every manager on the planet Earth recognizes this report. But the problem is, when the manager receives this report, they ask themselves, how much insight and understanding do I get about the cost that I can influence and control, and where it went? And the answer is not much. Notice at the bottom, I say, when managers get this kind of report, they are either happy or sad, but they are rarely any smarter. And the problem is not that the report is bad. The report is actually a good report. The problem is the data in this report is not structured in order to basically answer the question. So what activity-based costing does is it makes them smarter. It converts that $914,000, see to the left, into the middle, into the language of work, key scan claims, analyze claims. Notice that I'm using the back office of an insurance company. It's a factory too. And then it reassigns each activity cost into the products and services and customers, just like the waiter or waitress in the restaurant, using some sort of cause and effect relationship. So we're basically converting the inputs into the outputs, where they go. Now, it isn't quite as simple as I just described. I've rotated the previous slide 90 degrees. You don't just say, oh, I take my ledger expenses, I create some cost pools of activities, and then I trace them to the cost objects. It's more complex. The right side shows that you will have support departments that support other support departments that ultimately support the frontline departments that interact with customers or make products or deliver services. So it must be a multiple stage cost assignment network. I want to warn you, the next slide is going to be complex, but I want to educate you. And because I am going through this fast, if you want to learn more about activity-based costing, if you go to the IMA website, I did write a statement of management accounting. It's got 30 pages. It's called Implementing Activity-Based Costing, and you can read that at your leisure. Okay, here's the diagram. It's not as complex as you think. It does have the three universal components of any organization: resources, the top, the work activities in the middle, final cost objects at the bottom, okay? Now you need to adjust your thinking. This is not a process flow chart end to end with swim lanes. This is a reassignment network. So let's say a company spent 2 million euros, I'll use Europe currency. In January, it will be the exact same 2 million euros of work activities, and they will pile up at the bottom into the final two of cost objects, the same 2 million euros. They'll actually pile up into, at the bottom, the customers and something called business sustaining, which I'll describe in a second. All of those arrows, think of them as the diameter as thin straws or wide pipes, where the diameter reflects the amount of money going through. That's why it always reconciles exactly top to bottom. At the bottom module, I call this the predator food chain. You know, like large mammals eat small mammals eat plants. The customers are the end of the line because they're consuming the products by purchasing them, or the service lines. But you'll also notice, and this is important for trend number one, there's some of those activities are going directly to the customers, not to the products. Those would be things like making sales calls or customer service. Quickly, business sustaining is a special category. There will be some expenses that have nothing to do with making products or serving customers. Things like the legal department, okay? So we create a special category there with cost objects like senior management or board of directors or regulatory agencies, and we trace them there, and we never reallocate those to the products and services because there's no relationship. Business sustaining is typically 10 to 15% of an organization's monthly expenses. You still need to recover them with pricing to be profitable. You just can't assign them. Direct costs, not broken. You may have data integrity issues with it, but that can be solved. Let's look at the consequence when you do ABC compared to the traditional butter spreading. The butter spreading is the horizontal axis here. The ABC is this curvy line. The vertical axis is the magnitude, the percent error distortion that you get when you compare the correct way, ABC, with the traditional butter spreading. And the error is not 5 or 10%, it can be 50 to 100%. To the left, that's going to be like you in the restaurant. You know, if they split the check evenly, you'd be subsidizing those other three. So it's really hidden profit. To the right side, that's those three people with eating the most expensive items. Those are really, actually, they're losses, but that doesn't really appear to be. Okay, this is what's more important. What does one see after you've actually calculated ABC? And it's always organization shock to the management team. Okay, how does the graph work? And we refer to the graph as a whale curve because it always looks like a humpback whale. And you're looking at real data here, incidentally. The vertical axis is the net revenues minus the properly calculated ABC cost for each product. The horizontal axis is the cumulative buildup of the profit, and it is rank ordered from the most profitable product to the second most profitable product and so forth. You will notice in this graph that they made roughly $8 million of unrealized profit on 3/4 of their most profitable products, and then they lost $6 million on the remainder to net out at $2 million. And the last data point will always reconcile exactly with the P&L. This company had 30 million in revenues, 28 in expenses to net out at 2. But the belief system of the company is that the graph is this thin blue line. And the problem is all of that butter spreading allocations misleading was crushing and suppressing, if you will, any accuracy. And the ABC multi-stage cost assignment network was detecting all of that diversity and variation using driver quantities to basically reflect and correlate with the consumption rate. So the top line is accurate, the blue line is wrong. Now, some of you may say, well, what do you do with those unprofitable products to the right? Do you drop them? No. That could be a mistake because some organizations deliberately have what are loss leaders that are associated with more profitable products so that they will sell them. Also, management accounting does a very bad job with product lifecycle costing. All accounting typically is period-based, January, February, March. So if we have a new product that's just been released early in its product lifecycle, may not have much revenues and there's some extra work while we stabilize it, so it'll be unprofitable. But each time we recalculate, it will migrate to the left. But at least that top line is fact-based data. At least the top line is fact-based data. And remember this, in the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one, but usually the biggest opinion wins, which is the opinion of your boss or your boss or your boss. So to the degree those higher level executives are making decisions on intuition or gut feel or flawed and misleading data like the blue line, your organization's at risk. So here's a generic diagram of the same whale curves. The flat line is without ABC. The first whale curve above it is basically when you use ABC. But then the next one is when we actually start making decisions, operational cost improvement, cost management. We lift the entire whale curve line up, and then we get the strategic one. Now, there's more here that meets the eye in the whale curve. Each of those data points to the right, what's really happening is each product or service line is reaching up into the work activities and asking, how much of each of you did I uniquely consume? And it piles them up like pancakes, where the thickness of the pancake reflects the quantity of the driver times the unit level cost consumption rate. And we'll come back to this later, but basically this gives operations people some insights. If I can reduce the quantity, frequency, or intensity of the driver, then the stack will go down and we're getting cost improvement. Now, here's another problem. It has to do with accountants. I love this graph. The vertical axis is the mathematical skills one learns, and the horizontal axis is your stage of life. So, you know, when you're 5 or 8 or 9 years old, that's the number counting. And then in grade school, we learn basic, you know, addition, subtraction, multiplication, division, then geometry, then algebra, then trigonometric, then complex, then calculus. We're learning all that. We're now in college. And then where do we go? Boom, back to spreadsheets. Too simple. This is a frustrating cartoon for me. The signpost says the answers. The people going to the left are following the simple answer, but it's wrong. The very few people taking the path to the right knows it's a little more complex, but it's correct. We need to start taking the right path. Doing activity-based costing is not that complicated. And you'll notice those people are falling off the cliff. They're going bankruptcy. So now I'm still back to trend number 1. All of that was basically preparing you to understand the shift from product-centric to customer-centric. The only value a company will ever create is the value that comes from its customers, the current ones and the new customers acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like your existing profitable customers. But we have a few problems. One, the CFO and the accountants are not measuring customer profitability. They're stopping halfway. They're only measuring up to the product gross profit margin line. They're not including any of the expenses of marketing, selling, customer service. And so that's one of the problems. Visually, what I'm saying is if this was a fictitious income statement, okay, there's the sales, the product, direct cost, the indirect, so the gross profit margin, $70. And that would actually be wrong if we were misallocating the overhead. But then what about all of the money below it, the selling, distribution? It's not visible. We've got to make it visible.